Two people put the same $100,000 to work, same market, same broad return. One bag sits almost alone. The other sits on a huge stack that was already compounding. By the end, you will see why the rich often get richer, even when the percentage looks fair, and how to use that same capital advantage math starting with your first dollar, without pretending the early stage feels equal. As of late 2025, the top 20% of households held nearly 72% of total US household wealth. That concentration is the backdrop. The useful question is the mechanism underneath it. This is where it gets personal. You can do the responsible thing, invest patiently, and still watch someone with more capital gain more dollars in a quiet month than you gained all year. It can feel like the game is rigged. Hard work still matters for income, but once money is invested, effort stops being the unit the market pays. Principle becomes the unit. That shift is what makes the early stage feel so strange. Curious neighbor asks the obvious question: if we both got the same percentage, why does their account look like it cheated? Because percentage is not the whole story. Principle is. Here is the reframe: compounding does not pay effort, it pays principle. The same percentage return creates a much bigger dollar edge for whoever already has more capital deployed. At an illustrative 8% return, $100,000 grows by about $8,000 in a year. That is the starter side of the same rate. $1 million at the same rate grows by about $80,000. Same percentage, a much bigger dollar gain because the principal was larger. Capital advantage means the money already working does more of the heavy lifting. New contributions still matter. They just join a machine that was already running. Contributions are how ordinary households create that machine. Nobody starts with the giant snowball. They start by feeding a small one until the dollar gains finally feel visible. This is not a speech about villains. Some wealth gaps come from luck, inheritance, power, or unfair systems. The capital advantage piece is still worth learning because it is the part you can respond to with behavior. New York Fed researchers showed a K-shaped pattern in real net worth since early 2023. The top income percentile's real wealth rose more than 25% from that starting point. Over the same stretch, real net worth for the middle group rose less than 10%. Financial assets did a lot of that widening work. Wages matter. Inflation matters, but invested capital can widen outcomes even when everyone feels busy. Once money is in assets that can compound, the dollar gap can grow without anyone working harder that month. The same research notes that lower-income households often faced higher inflation than average. So some households got squeezed on prices, while others gained more from asset growth. That is a hard combination. When people feel behind, they usually try one of three responses. Same pattern each time: vibe, trade-off, hurdle. Response 1 is waiting for a perfect lump sum or perfect moment. The vibe is caution. It feels safer to hold cash until the entry looks clean and the amount looks impressive. The trade-off is lost compounding time. Capital advantage begins when money is working. Waiting for perfect can protect you from one kind of regret and create another. The hurdle is confusing a buffer with a forever pause. Cash for near-term needs is smart. Holding investable money indefinitely because the start feels too small is how capital never forms. Response 2 is chasing a risky catch-up. The vibe is urgency. If large principal creates large dollar gains, the temptation is to force a home run and skip the boring middle. The trade-off is fragility. A strategy designed to erase a wealth gap quickly can also erase the small stack you already built. Catch-up risk can become setback risk. The hurdle is comparing your Chapter 1 to someone else's Chapter 20. Their capital advantage looks like genius from the outside. From the inside, it is often years of principle already working. A concentrated bet can create a fast story. It can also destroy the small principle you needed in order to ever reach capital advantage. Speed without survival is not a wealth plan. Response 3 is deploying capital steadily. The vibe is quieter. Contributions look small at first. The point is not drama. The point is giving future you a larger principal to earn dollars on. The trade-off is delayed lifestyle upgrades and fewer exciting stories. You may look less impressive, while your principal quietly becomes the advantage you wished you already had. The hurdle is emotional. Early on, even a good percentage produces small dollars. That is not proof the method failed. It is proof the principal is still young. Here is the middle turn. A fair percentage return is not the same as a fair dollar outcome. Markets can treat two investors equally in rate terms and still widen the gap in cash terms. That is capital advantage in one sentence. Yes, some people inherit capital or sell a business. Many others build it through years of unglamorous deployment. The mechanism is the same either way. Once principal exists, the dollar engine gets stronger. So pause on this privately. Are you angry at the percentage, or frustrated that your principal is still too small for the dollar gains you want to see? For starters, consistency builds the machine. For accumulators, protecting and adding to principal matters more than finding a clever new trick. Same math, different chapter. A high income with low invested capital can still miss the advantage. Income is fuel, capital is the engine. Without deployment, a strong paycheck can fund a busy life and a weak compounding base. Late starters are not disqualified. The capital advantage rule still applies. The honest adjustment is that contributions may need to work harder, costs need to stay low, and despair helps no one. Now the sober part. Understanding the math does not automatically create capital. Several traps keep ordinary households stuck in the small principal stage, longer than necessary. Trap 1 is a lifestyle that blocks principal formation. If every raise is pre-spent, there is nothing left to deploy. The capital advantage never starts because the capital never arrives. Trap 2 is friction. Costs, delays, and complicated products hurt everyone, but they feel harsher when your stack is small, and every dollar of growth matters emotionally. Simple and low friction helps the young principal survive. Trap 3 is despair delay. If you decide your contribution is too small to matter, you postpone the only process that grows principal. Feeling behind becomes a reason to stay behind. The gap is not asking you to gamble recklessly or hate people with more capital. It is asking you to respect principal, build it, protect it, give it time. Time in the market only helps money that is actually in the market. Waiting 10 years without deploying surplus does not create capital advantage. It creates a longer story about almost starting. The practical resolution is not a fantasy leap into the top wealth tier. It is building principal on purpose, so the same percentage math starts paying you larger dollars over time. First, separate your emergency buffer from investable capital. Money needed soon should stay safe and available. Money with a long job should be allowed to work. Second, automate a contribution you can sustain. The goal is not a heroic one-off. The goal is repeated deposits that make next year's principal larger than this year's. Third, keep the investing path broad and boring enough to hold. Capital advantage needs time more than it needs a thrilling story. A plan you abandon after one scare does not compound. Fourth, cut one principal thief. Often it is lifestyle creep, high-interest debt, or recurring cost that never improved your life. Freeing one contribution stream matters more than optimizing 10 tiny hacks. High-interest debt is especially harsh because it compounds against you. Every dollar trapped in expensive debt is a dollar that cannot join your capital engine. Clearing that drag can be part of building advantage. Fifth, change what you celebrate. A good rate on a tiny base still produces tiny dollars. Watch the principal growing. That is the leading indicator of future dollar gains. Progress often looks boring in year one and obvious later. The percentage may look familiar. The dollar gains get thicker because the base got bigger. That is the capital advantage arriving for you. Recheck after every raise. If income rises and principal contributions do not, you may fund a nicer month without ever buying a stronger compounding base. That is how high earners stay capital poor. You are not foolish for starting small. Every large stack was once a small one that kept getting fed. The early stage feels unfair because the dollars are small. The process is still the process. Do not wait to feel rich before you deploy capital. The feeling often comes after the principal exists, not before. Start with the surplus you have, then grow the surplus on purpose. And protect the stack once it exists. A buffer keeps you from raiding investments for ordinary shocks. A boring core keeps you from abandoning the plan after one scary headline. Back at those two bags, the lesson was never give up because someone started ahead. It was understand the machine. Same rate, different principle. Different dollars feed the principle. Your first real advantage is continuity, not a perfect pick, not a perfect month. A principle that is still there next year, a little larger, still working while you live an ordinary life. The rich get richer partly because capital earns on capital. That can feel unfair at the start and still be usable maths. Build principle. Keep it working. Subscribe to this channel for more clear money steps like this.